Hi, everyone, and welcome to UBS Trending. I'm Anthony Pastore. Thank you for joining us today. As we continue to follow the path of inflation, we ask, how much longer can this last? I'm sure you're all asking that same question as well. So are there any tea leaves out there that we can see that maybe give us a sense of the direction that we're headed? So we're going to talk about that and more today with Eddie Gabor, co-founder of Key Advisors Group. Eddie, always good to have you back on the show. Good to see you. So let's talk about this, Eddie. We had CPI come out recently. That's the Consumer Price Index. It fell to 7.7% for the month of October, which is the lowest figure that we've seen since January of this year. That's really just before the war broke out in Ukraine. So the question is, do you think that this reading is an indication that inflation has perhaps peaked at these levels and maybe that we're now on the other side of it? Or do you think there's more to the story here?
So I am in the camp that inflation has peaked. However, I think the market is misreading it and reacting the wrong way to that number. Because I think what the misconception is, in our opinion, is that now the Fed is going to pivot because the rate of change of inflation is going to continue to decline. And that's where we think the disconnect is. And we're going to find out here in the coming weeks when we get the inflation data for November that comes out in the first 2 weeks of December. I think inflation is going to stay sticky. So even though it's peaked, we don't think it's going to come down substantially here over the next quarter or two, because energy prices are going to stay high, in our opinion. Rents are going to stay high. Food costs are going to stay high, and healthcare costs are going to stay high. So inflation is going to be stubbornly high for the next few months. Now, I do think over the 12-month period of time, we will see a decline, but that's going to come at the expense of the economy. We are not going to get inflation down to a level that's going to make the Fed happy until we have a recession. That's our opinion. And I don't think the market is priced in that scenario, which is why we're being very cautious heading into the month of December.
And you know what, Eddie, it's a good point because it's a perfect segue to talk about Jay Powell and the Fed, because at their recent meeting a couple of weeks ago, Powell said, and I quote, "It was premature to think about a rate pause and a quote-unquote soft landing for the economy." And of course, that's one in which rate hikes don't lead to a recession. So he said that that may not be in the cards. So it seems like Powell is even indicating kind of that, you know, we may be headed for a recession. And as you use the word, sticky when it comes to inflation. So what's your takeaway from what he said, and what's the feeling for you about the R word, recession, here in the U.S.?
So in my opinion, I don't think there's any doubt we're heading for a recession. I think it's going to be deeper than most people are pricing in. This is the worst setup the consumers had, in my opinion, since the 2008-09 Great Recession, when you look at consumer debt and everything that falls into place with that. But the biggest thing I took away from the Fed meeting is Chairman Powell basically indicated that they would rather over-tighten than risk pausing too early and having inflation spike again. So when you think back at the context of what that means is, the only way you know if you over tighten is if the markets fall apart and the economy falls apart. And that's ultimately, I think, that we're going to have that Volcker type of Fed where they're just going to keep tightening until the data that they look at supports that the work that they're doing is working. The unfortunate thing is the data they look at is rear view mirror data. So by the time they see the labor market weaken to where they want and inflation down to where they want, the damage is already done. So the bottom line is we came away from the Fed press conference as them being very hawkish, and they're willing to over tighten because that's what they've told us. And I think the interesting thing is this: the Fed has told us exactly what they're going to do, yet investors have tried to find a reason as to why to not believe them for some reason. And all it's done is cause them to continue to lose more and more of their wealth because they don't believe the Fed's going to keep tightening.
Mm-hmm. Well, let me ask you then, Eddie, in your opinion, do you think we're getting set up here for a 2008, 2009 level of a recession with that kind of intensity?
I do. I think it'll be different because everyone is different. But for the consumer, we've had trillions of dollars of wealth wiped off of the globe because of the crash in crypto, the crash in technology. And we haven't even had the housing bubble pop yet. And that's going to be the next shoe to drop is housing. So the wealth effect is more dramatic now than it was in 2008-09. Now, do I think housing will crash like it did back then? Probably not, because the debt behind real estate is better. But I think anyone that is overlooking the amount of wealth that's wiped off and assuming that that's not going to have a big impact next year is misinformed. Because look, this consumer spending data and how resilient the consumer is and everything we've been reading about the consumer, when you look under the hood, one of the reasons why is because of the debt levels they're continuing to put on. So when you're spending money out of your pocket, it's a lot different than when you're putting it on a credit card.
Right,
and so
exactly.
we're starting to see signs now that next year the consumer is going to be in serious trouble.
Okay, well, we're going to have to keep track of that, Eddie. But, interestingly, it's sort of a pivot towards what's going on with the U.S. dollar. It's been quite strong versus particularly the euro for the last 12 months or so, even against the great British, the pound sterling. And we are aware of the fact that England is having a fairly tough time economically as well. But back to the dollar, do you think that strength in the dollar is going to continue into next year?
I do. I think the dollar is going to stay strong because I think the Fed is going to continue to tighten monetary policy. And the other thing, too, is to your point, which is a great point, we are, in my opinion, heading into a global recession, and we're still the best house in a bad development right now, essentially, even though our economy has plenty of problems. But when you look around the globe, the other areas are struggling a lot more than we are, which is going to keep that dollar strong, which again means the multinational companies are going to have to revise earnings because that strong dollar hurts their bottom line. So that's going to continue to be a headwind for the markets here over the next 3 to 4 months.
You think earnings are going to take a hit because of that?
Without question, in my opinion. And that, again, is not priced into the market. Everything we're hearing is the bad news is already priced in. Well, when you look at what they're expecting company earnings to do next year, I don't agree with that at all. And I think you're going to start to see those revisions happen in December, which is why I do not think we're going to have a Santa Claus rally. We raised cash Friday. We're going to continue to raise cash. So that way we can buy this dip that we think is going to bottom sometime in the first half of next year.
Great. Thanks, Eddie. So let me ask you then, when you're looking at 2023 and clearly you're looking for ways to best invest money for yourselves and your clients, what's your outlook for the first half of the next year? And from a sector perspective, who do you think the winners and losers are going to be within that investment landscape?
So again, our opinion, and of course we could be wrong, we think we're going to have some of the best buying opportunities we've seen in a very long time in the first half of next year. So although we're bearish heading into next year, we're extremely excited because of our cash position. So I think the first part of the year sets up to be pretty tough, and we'll test new lows. I think there could be at least a 15+% drop in the broader market between now and the first 4 to 5 months of next year. And then I think you start to see asset prices turn because the market will start to recover well before the economy. And one of the areas we're going to keep a very close eye on that I think could potentially have a lot of upside is going to be small cap stocks because they generally are first ones to come out in a recession. They don't usually have as much dollar risk as some of your multinationals. And they've also taken a pretty big beat. And so the small cap space, I think, is going to be a great place to be. Energy, I think, is going to be a good long-term hold as well, too. Technology, look, if you get the NASDAQ down 50% from peak to trough, which is what I think you'll be able to buy it at sometime next year, that's also going to be a good entry point. But investors need to be careful. The tech, in my opinion, is not going to snap back as quickly as it has in prior years because we have to get used to this new normal of interest rates staying higher, the capital cost to businesses staying higher, and growth being slower. So that's our take for next year, and we'll have to wait and see if we're right.
Yeah, if only we had that crystal ball. Maybe we could ask Santa Claus for that. Speaking of Santa Claus rallies. Eddie, thank you very much. It's always a pleasure to have you join. Happy holidays to you, sir.
Thank you. Same to you.
Yeah, we'll see you soon, Eddie. Thank you very much. And don't forget, Powell himself said that it was probably, very premature to think about pausing. So we're going to probably see some higher interest rates here for quite some time. So that's going to do it for our show. Thank you for joining us. For more information, visit us at ubs.com/views. Our website is chock full of great information for you from UBS and our best partners. But also, you can make sure to follow UBS on various social media platforms like LinkedIn, Facebook, Instagram, and Twitter. Plus, all of our past UBS Trending episodes are available for you on demand. And as always, if you have questions about your own portfolio, we encourage you to speak with a financial advisor. Until next time, I'm Anthony Pastore. Have a great day, everybody. And remember to keep your eyes on what's trending. We'll see you soon.